there, I want to thank you for your interest in private lending. I want to show you this afternoon how to triple the returns you're making currently on bank deposits, and I want to show you how to do that both safely and legally. And I think it's a very important step as you consider your personal investments. You know, we all work very, very hard for our income, and a lot of us have it stored away in 401ks or IRA plans, and certainly we've seen in the last couple of years, we've seen the value of our portfolios. A lot of us have gone down, and almost the point where some of the investments we currently have seem rather speculative. I want to show you something today that's a little bit different. It's not speculative. It's a lot safer and a lot more secure than what you may have some of your money in currently. It also yields a lot more. You can certainly take your money to the bank and get a CD, a certificate of deposit, for maybe 2%, or you can invest it in a little bit different vehicle, which I'm going to show you today, private lending. And because of that, you can earn 2 to 3 times what you're currently making at the bank. And the nice thing is it's a short-term investment just like the bank. So rather than dealing with a 30-year mortgage, if you would, because nobody wants to do that, you're looking at anywhere from 6 months to 36 months, pretty much the exact same thing as a certificate of deposit. So today we're going to learn 4 specific things. I'm going to show you what actually a private real estate loan is. We'll also show you how it works, and I'm going to show you the benefits. But I'm also going to give you some downside to real estate lending, and I'm going to show you how you personally make money. And of course, keeping your money safe and secure and insured is another really, really good thing. The first thing that you want to consider is finding out really what a private real estate loan is. And as you can see on the screen in front of you, it's really nothing more than a loan secured by real estate. And it's usually funded by people like yourself, who's a private individual, or you may be using some of your retirement funds, which we'll get into in just a minute. But it's very, very, very simple. And this concept has been around for a long, long time. It's very easy. Basically, the concept is something that really started, you saw it a lot in the 1800s and early 1900s here in the United States. This is before the banks became these big, huge conglomerates and were lending everywhere. And oftentimes private folks helped out their neighbors or other people by loaning them money and investing their money with them in order to acquire real property, or maybe even to do fix-up on property, or whatever the case may be. And then they got a great return on it. And so we're going to show you today how you can get a return that's a lot greater than what you're getting at the bank, and how you can help out a lot of people, people like the person who owns this website. And we're going to show you how to do all of that. The other really cool thing about private real estate lending is that it produces a predictable income stream for you. And you'll learn in today's presentation that you can choose to get monthly income like a lot of retirees do, or you can choose to let it sit and accrue in your investment, somewhat like a CD. You know, the CDs, the banks don't pay you every single month. You can also do that as well with this type of investment. Keep in mind that what's cool about this investment is it provides security, protection, and recourse, which means that if the deal goes upside down, you have recourse because you can take the property back and resell it yourself. And so I'm going to teach you today how you can get into these type of investments for low risk. And I want you to really note some of the things that you should and should not do, in my opinion. And also, one of the things I would also suggest is that you avoid some of the online services that have sprung up, kind of like a whole Napster type thing to the real estate community, in which there are people out there who have private money to lend, who are getting involved with real estate investors, and they're just kind of hooking them up via sites on the internet. I wouldn't recommend that. I would recommend that you look to the owner of this site to teach you and work with you and show you more about private lending, to give you some of the special reports that we prepared, and to really make sure that you understand everything before you ever write a check. That's very, very, very important. So even though these type of loans do provide security and protection and recourse, the bottom line is you have to be very comfortable in doing it, or you shouldn't do it. So this presentation is designed to help you become more comfortable and more familiar with this type of investment. Now, the really cool thing is that you can make this investment in pretty much any amount you want. We have a lot of customers who are using their IRA, and you can roll your IRA over into a self-directed IRA, and you can do that through a company like Equity Trust Corporation. They're a third-party custodian. What's cool about the IRA is that income can come into the IRA and it can be tax deferred. So your IRA could loan the money, and then all the money you make can go back into your IRA, and it's tax deferred. So just right now, your IRA might be investing in stocks and might be returning you 2 to 3%. Your IRA could instead invest in this type of investment. They get you anywhere from 7 to 12%. So keep that in mind, and also know that you don't have to have a large amount of money to get started. You don't need, $100,000, $200,000, $300,000, $400,000 to get started. You can get started in many cases for as little as $20,000 or $30,000. It certainly depends on the area in which you live, and it also depends on how comfortable you are for whether or not you're in first or second lien position. Again, I'll explain a lot of that throughout this presentation today. I just want you to understand that you may not think you have money to invest, and the reality is you've got retirement money that's currently earning bank rates sometimes or less. And by the way, if you're earning bank rates, you're losing money. I don't know if you realize that, but if inflation's going up to 5, 6, 7, 8%, and it's headed more, the more that we print money, the more inflation's going to be. If inflation is headed up at the rate of 8, 7, 6, 7, 8%, and the bank is only returning you 1 or 2%, your dollar is not worth, your dollar's not keeping up with inflation. So you've got to be earning at least 7 or 8%, just really to keep up with what's going on in the economy right now. So please understand that you don't have to go sell off, half your assets to get money to invest. You can invest already with what you have in a retirement account, 401k, kind of profit sharing plan, Keogh plan, whatever. But it's very, very simple on how all of this works. Private lending is so simple. Basically, the bottom line is we buy properties. And in order for us to buy the properties, we borrow the money from you, and you earn 2 to 3 times the bank rates. It's as simple as it gets. Now, there are things that we're going to do that will protect you when we do this. But let me show you really what I'm talking about. Right now, if you were to deposit your money in a bank, and let's say the bank just pays, for grins and giggles, 2%. And over the next 36 months, you're getting 2% annualized on your money. And all that money stays in the bank. And at the end of 36 months, you get your principal back, plus you get whatever interest is accrued. You get the 2% per year interest that's accrued on it. Okay. Now, that's what banks do. So you could put your money in with a certificate of deposit or a money market fund or a savings account, and the bank is giving you low interest rates. But the other thing is the bank is really paying you low interest rates, knowing that they can loan that same money out to somebody else at a higher interest rate. Banks give personal loans, banks give auto loans, banks give home loans. They loan money on deposit from you, which we're paying 2% for the right to use, and they're loaning it to somebody else at 8, 9, 10%. And what they're doing is they're making the spread. Okay. So you can do the same thing the bank does. You personally are a private bank. You make the loan to us. We use it to buy the property, and the loan was either used for purchase price or rehab costs. You, in turn, earn 2 to 3 times the bank rates, and you become the bank. Now, here's what's really cool. Because it's your personal money, you don't need a lending license. If you were loaning out somebody else's money, obviously in most states you would need a license to lend. But right now, if it's your personal money, you don't need to lend it. You don't need a license to lend it. So if you wanted to loan it to me, and we would secure it by a property, you don't need a license to do that. So these investments, while they certainly are looked at, and we're going to close them through an attorney or a title company or third-party agency, the point is that you become the private bank, which is really phenomenal for you. And it works very, very simply. And we'll start in the lower left-hand corner of the screen here, where it says that we buy property. So our job as real estate investors and property investors is to go out into the marketplace and find good deals. The deals we find might be properties that are owned by bank. They've already gone through the foreclosure process and the bank owns them. And because the bank's trying to get rid of them, they're dumping them at 50, 60 cents on the dollar, which is a phenomenal thing, and it becomes a very safe investment. Maybe we've got some properties that have been abandoned, or maybe we've got people who just need to get out from underneath their payment and move on to something else. All of these cases, really, the use of private money helps us as real estate investors close the deal a lot more quickly. Certainly if we went to a bank, banks are still loaning money, but certainly not to the same people that they were loaning it to 2 and 3 years ago. I may have qualified comfortably at a bank 2 or 3 years ago, and I may not qualify today because lending regulations have changed and banks are regulated more heavily now than they've ever been. So understand that the use of private money by property investors like myself certainly helps us in our business. We don't mind paying a higher rate than you would get at the bank. You win because you're getting a higher rate than you would get at the bank. So here's what happens. We buy the property, you provide the financing. And when you provide the financing, we want to make sure that we protect your money. And so we're never going to go above 70 to 75% of the value of the property once it's fixed up. Okay. There's rare occasions we'll go to 80%, but that's very rare. Usually we're going to be able to buy a property for a little bit less than that, and our 70 to 75% usually will include our acquisition price as well as our fix-up price. Sometimes we put our own money in for the fix-up, and then we turn around and we sell the property. But in the meantime, when you provide the financing, the third thing that happens is that we give you documents that secure your loan. Now, rather than you just sitting down at my kitchen table and writing a check, everything is done through either an attorney or an escrow company, depending on the state in which you live, or a title company, again, depending, it's all state specific. These are third-party bonded agencies that are insured to collect money and complete the transaction. So you would wire your money to the title company. I would never touch it. Okay, the title company in turn prepares all the paperwork and make sure that your money is distributed directly to the seller or into an escrow account if I'm using any of it for fix-up. That said, how in the world is your investment secured? Well, pretty simply, I, as a property investor, am going to sign several documents that will ensure you, the lender. One of the things I'm going to do, and this is the same thing, by the way, that if Countrywide were to give out a loan, Countrywide's going to do the same thing. It's the same documents. These are no different than standard lending. So I'm going to sign what's called a note, and that's an IOU, where I promise to pay you back, and it's got the terms of my repayment. It's going to have your interest rate in the note. It'll have how long that we've got to pay it back, and usually the note's anywhere, like I said, from 6 months to 36 months. It's totally dependent on what you're comfortable with and whether your needs match the needs of that particular deal. So you're secured by the note. You're also secured by a publicly recorded lien against my property, which means that you're going to get what's either called a mortgage or a deed of trust. And I'm basically signing a document that says if I don't pay, I don't stay. So in other words, you have the right to take the property back at any time, provided that I'm not performing, living up to my end of the bargain. Okay, so you're protected not only by my note, but also by a deed of trust or mortgage. And then there's two other items you're protected by. If the property were to burn down, we have a hazard insurance policy that has you as the loss payee. And all that means is if the property burns down, the first person that gets paid off from the insurance policy is you to recoup your money. The fourth thing, which is very important, is that we're going to acquire title insurance. And all that is it's an insurance company. That's what a title company is. It's an insurance company that is ensuring that there are no other liens against the property that would affect your lien. So if you're in first position, you want to know that you're in free and clear first position and that nobody else has any rights before you. That way, when the property gets sold, you're the one that gets paid off first. So the documents, again, that secure the loan are the note, the deed of trust, the hazard insurance policy, and the title insurance policy, and you are the beneficiary or the payee in all of those. We go ahead and rehab the property. We turn around and sell the property. And the bottom line is when we sell the property, you get your principal and your interest. Now, in most cases, it takes us 150 days to rehab a property and turn around and sell it. Because remember, we're going to be fast in our rehabs because the quicker we get this done, the more money we're saving. I will tell you that there's many cases we pay our investors a minimum of 150 days interest just to make sure that the whole investment is worth their while, whether or not we close in 150 days. Now, there are some downsides. What's one of the downsides? Well, what if the house doesn't sell as quickly as we thought it would? Well, that's great. Your money's tied up for longer, but you're still accruing interest at the agreed upon rate, at the note rate. So if we wrote the note at 8 or 9%, you are still accruing interest at that. Also, we work personally with our investors so that if you need the principal back for another investment, you just need to let us know so we can replace your investment with somebody else's money if, again, this investment runs long. Please understand, though, that if we have a timeline on this investment, that we do need the investment for the full timeline. There's not any negotiation on that. So if you say, well, yeah, I'm comfortable with my money up for 6 months, obviously we need the money for the full 6 months. And once in a great while something happens where you need the money for an emergency, what we'll do is we'll work with other investors to see if we can replace those funds and get yours back as quickly as possible. So it's a kind of a give and take thing. You're not working with a big, huge, faceless company. You're working with individual, and that's why it's important that you really get to know us and understand what we're all about. So we rehab the property, we sell it, you get the principal and interest back, and sometimes you may want to keep your money in for longer term. I know that if we're renting the property out and you're comfortable with a little bit higher rate of return, you might want to keep your money in, just like a CD, for up to 36 months. You're certainly welcome to do that, and you will get a higher return because of it. So it's kind of we're not juggling here, but it's kind of like a little balancing act, in that if you want to keep your money in longer, you get a little bit more money. If you want to wait, just like a bank does on a CD, if you want to wait for your interest until the end of the project when we sell, and by the way, your interest accrues every single month, which means that every single month we send you a report on what you made that month, even though you're not taking in cash. That is an option available for you. So keep that in mind, that we let you know how much money you're making, and then of course we pay you off at the end. On the other hand, if you want cash flow along the way, we're probably going to pay you a little bit less in interest, time value of money. However, if you're on a fixed income, what a great thing to do is to get that. So that's basically how it works. We buy the property, you provide the financing, we secure your loan with documents which are all publicly filed, we rehab, we sell, and then you get the principal and interest. It's really very that simple. But let's give you an example here. And I want to show you how our private lending program can really work for you. Let's say that you have $100,000 that you want to loan. And remember, I told you at the beginning of this presentation, you don't need the full 100. Okay, if you only have $20,000 in an IRA, you certainly can invest that. If you've got more than 100, you're welcome to invest that. But I'm using 100 because it's just easy math for everybody. And again, remember also that this little section right in here, I do not want you to go over the 70 to 75% loan to value. So what we did here was we said the market value of the house when it's fixed up, if you look down here, is $142,000. The loan to value is 70%, which is exactly at $100,000. And so you're going to earn, in this example, 8%. Now, 8% mean if we do this, it's the interest rate. 8% is calculated on the outstanding loan balance. We're going to let you charge a service fee up front of an additional $500, which really pays you for your time to pull the money out, get the money over to us. It's a courtesy we like to give our private investors. And then let's say that we take 150 days, that's number 4, down here to fix up and resell the house. Okay, if we take that 150 days and we're paying you 8% a year, then what it boils down to is at the end of 5 months, 150 days, you have earned now 8%. You've earned, if you look down at the bottom of your screen, $3,333 in interest in that period of time on your $100,000 investment. You've also earned that $500 loan origination fee. So really what you made in 5 months on that $100,000 is you're going to end up making $3,833, as you can see in the lower right hand corner of your screen. That's what you've earned in 150 days on a $100,000 investment. Again, with a $500 origination fee plus 8%. Let's compare that, if you would. Well, we'll just show you. So let's say we've got your first loan's paid off after 5 months and you made that money. And then let's say that you just say, oh, I want to keep my money in. So we borrow it again. So that first 5 months, you're going to make $3,833 in interest and on the origination fee. On your second loan, 5 months later, you're going to make the exact same thing. And let's say at the end of the year, month 10 rolls around, we've paid us off twice. You said, you know what, I'm going to invest again. So now you're going to get another $500 origination fee, and you're still going to get that 8% a year divided by 12, whatever that comes out to per month, you're going to get that. So the last 2 months of the year, you would make $1,833. Bottom line is the total income earned for the year is $9,499, basically $9,500 on a $100,000 investment. That's roughly, because of the $500 origination fees, that's roughly about a 9.5% return, even though the note was only written at 8%. Now let's compare that with a bank. You know, you take your same money to a bank. We're going to go high on the bank's interest rates. In today's market, it's usually 1.5 or 2. But let's just say for whatever reason you found a great deal and the bank is paying you 3%. Well, you're going to get $3,000 in interest on that same year for the same use of that money. So your choice is you either make the $3,000 or you make the $9,500, and that's totally up to you. But if you do the $9,500, you're now $6,500 on the plus side, because you're getting a better return on your investment versus on a CD. So you're going to make a whole lot more money. and let's just take that and add this up. You know, if you look at a 10% rate of return versus a 2% rate of return, and you look at what's happening over time here, over 10 years, a $10,000 investment earning 2% is only worth about 12 grand. That same investment with those same 10 years, if you're getting 10% return, is worth 25 grand. So you can see just from this graph right here that getting more on your money, especially over a longer period of time, is absolutely phenomenal in the returns that it's going to give to you and the money that you're going to make with your money. Okay, so that said, let's talk about the up and the downsides of this type of investment. Well, one of the upsides certainly is you're going to get higher interest rates than comparable investments. So you're going to get a higher interest rate than you would at the bank or in a money market account or a CD or any of those things. And the risk is pretty much the same. You know, it was just recently announced that the FDIC, who's insuring everybody's deposits, is now borrowing money from the people that they insure. They're borrowing money from banks, which is kind of crazy. So, you know, there's no givens and there's no guarantees in this world. That said, there's certainly things with more risk and or less risk. I would always suggest that you choose the stuff with less risk. One of the things I love about your real estate investing here is that, number one, you're not dealing with tenants and toilets as a problem. You become the bank. Your bank never comes out and changes a light bulb. You don't have to deal with that. You still make a phenomenal return on your money, you know, 2, 3, 4 times what they're paying you at the bank, but you're not dealing with the hassles of tenants and toilets. So that's a really phenomenal, is the way I look at it. That's a phenomenal thing. And you're getting higher interest rates. Now, the other thing is the value of the property is really not going down. Yes, in today's market, it's pretty much bottomed out, you know, but let's say that, you know, it's bottomed out and the property is only worth $50,000, and you invest up to 70%, it's 35, and you know that the market's headed back up again. You know, the more the market heads up, the more secure your investment becomes, which is a really good thing. The second benefit of a private real estate loan, as you see on the screen in front of you there, is title insurance. Again, this is insurance that's given to you from an insurance company. That's all a title insurance company is. It's an insurance company. And title insurance secures your lien position against any other encumbrances. So, you know, nobody could ever come and say, well, no, I'm in first position, because the title insurance company did a complete research on the title of the property and made sure that if you're the first lien lender, that you get paid off first when the property either refinances or sells. That's very, very important. Anytime you do private lending, it's important that you make sure that the property investor gives you, the lender, title insurance. It's extremely important. The other thing that's really cool is there's a steady income stream. If you are a well, let's say you're retired. I'll give you a great example. My cousin is retired, he and his wife, and they're one of my private lenders. They've elected to receive money every single month. Well, that's great. They've got, you know, a good amount invested with me, and every single month I just write them a check. And so they're living off of that income. And you can set your private lending up in such a way that you too could live off that income if you wanted. You're probably going to get a little bit less than if you opted to leave it in the investment for 36 months and get all your change at the end, or your interest at the end, just like on your CD. But the point I'm making is it's really, really up to you here what you want to do with it. There are other benefits. The collateral itself provides a safety net. The collateral for your loan is a lien against the property. And it's collateralized in a couple of ways. One of the cool things with the lien is that if I ever stop paying, you can just take the property back. Now, you may not want to be a property owner, but you're certainly entitled to the asset that's worth, in this case, probably 30% more than what you loaned on it. Because remember, I only want you to go in at about 70 to 75% of the value of the property. So the collateral for the property is your lien against it, and that comes from one of those documents that we talked about earlier, which is the mortgage or the deed of trust. And it's publicly recorded. So anytime the property is sold or transferred, or there's a new loan put on it, you're guaranteed to get paid off first. That's the way the title companies work. Anyway, so the other thing that's really great about these types of loans is that they're short term. You know, if you were a quote-unquote lender, a lot of folks, you know, are freaking out. Well, I got to loan money for 30 years. I don't want to do that. Well, no, that's not the case. See, what's nice about this type of loan is that you're only into it for 6 months, maybe up to 36 months. But the decision is totally up to you. I have clients who prefer short-term investments. I have clients who prefer long-term investments. I have clients who want me to pay them monthly. I have clients who say, you know what, leave my money in, give me a higher rate of return, and pay me when the project's complete. It's totally 100% up to you, and we need to discuss what you want so that when I have an investment or a property that comes along that I know matches your needs, then you and I can discuss moving forward. But I don't want you to move forward with something you're not uncomfortable with. The short-term loan, because it's short-term, provides it's less risk. You know, if you've got your money tied up at a certain interest rate for 30 years, you're taking a big risk that the markets are going to change drastically. On the other hand, if you've got your money tied up for a shorter period of time, it may mean that the market turns around in the next couple of years and that the going rate on our returns for you might go up. We don't really know that. So, you know, for you to be in a little bit shorter term, by short term I mean, you know, 6 to 36 months, it makes a lot more sense for you. And finally, what's really great about this is your principal's secure because the property is not going anywhere. You can drive by and actually see your property. Now, sometimes, yeah, granted, there are times that, you know, you are going to secure a property out of town. I'll give you an example. I've got one right now with an investor in one state who has a private lender like yourself in one state who's loaned money on a property that I have in another state from which they live. And, you know, they really don't care because they've done business with me for a long time. They get monthly payments on this. They wanted monthly payments. It was a small amount of money for them to invest. And they're really, really excited about the returns that they're receiving. And as long as they get the payments every month, everything's cool. So, you know, please understand that. Which brings up another upside downside, and that is this. Don't invest with me until you've met us. Don't invest with anybody until you've met them and you feel comfortable and we've given you social proof on what we do and how we return money to other investors. And once you're comfortable, then and only then should you invest. So, you know, I'm not soliciting money from you right now. I am saying, let's create a relationship. Let me teach you a little bit about private lending. And as you're comfortable, and the more comfortable you get, the better off we both are. So you're going to make money in one of a couple of different ways here. We're either going to pay you monthly or quarterly. It's totally up to you. Or we're going to pay you at the end of the project when the house is either refinanced or sold, at which point you would get your money and your interest rate then. And so you've got several different ways here. You can get monthly payments, but you're going to get a lower return if you get, you know, you pull your interest out monthly. You can use quarterly payments. And again, your returns can be a little bit higher, but it's still not going to be as good as if you wait, let your interest accrue every single month, and then get a lump sum at closing. And by the way, when your interest is accruing, you want to make sure that anybody who's working with you, like myself, I always give my clients a statement at the end of every month showing them how much money they made, even if I don't pay them. In other words, if you go to the bank and you get a CD for 3 years, you know, wouldn't it be nice at the end of every month if you're getting a statement and they say, hey, by the way, this month your CD earned this, or, you know, total your investment so far, you've earned this on your investment. That's what you need. So that you know what you're earning, even if you don't pull the cash out for, you know, 36 months. That's fine. It's nice to know what you're getting along the way. So today we've talked a little bit about private lending. I've given you some insights as far as how I want you to invest. I don't want you to go over 70 to 75% of the value of the property. I've told you that you can earn 2 to 3 to 4 times what they're paying you at the bank. Your investment is secure. It's insured with title insurance and hazard insurance. And it can be short term. Pretty much you dictate the terms. So you dictate pretty much how you want to invest, which says a lot, especially if you've got your money in a 401k right now and you have no say-so over how they're investing it for you. My suggestion to you would be to go to a company like ETC and convert it over to a self-directed so that you have a say-so in what you're investing in. I put this at the last screen a little bit. We laugh about it. Private lending is not just for bankers anymore. That's really a little joke. At the bottom line, it really isn't. There's so many private loans that are going on in this country right now that are fueling the resurgence in real estate and fueling, really helping banks get rid of unwanted properties and helping homeowners move into properties that have been newly rehabbed. And we would like to work with you on that and certainly give you a great return on your money. Hopefully a lot better than what you're getting right now. If you have more questions, which I know you do, what I'd like you to do is when you go back into the website, just contact us, pick up the phone, give us a call, drop us an email. We'll be more than happy to work with you in any way we possibly can to clear up any misconceptions that you have or just to answer any questions you might have. We'll also show you how other folks like you have earned property, earned a high rate of interest in this type of investment. So if you would, just like I said, just go back into the site, pick up the phone. If you have any questions or you want to even download some more of the free reports, please feel free to do that. We just want to show you over time how we work with our investors in giving you a great, safe rate of return that's 3 times what you could get at the bank.